Welcome to the new reality. A reality where fundamental analysis is dead and charts are drawn not by supply and demand, but by the mood of a single man in the Oval Office. You thought you were trading silver? You thought you were investing in green energy or hedging against inflation? Wake up. The last 48 hours have shown us the true face of the market. This isn't an exchange. This is a slaughterhouse. Remember these dates, January 21st and 22, 2026. In financial history textbooks, this period won't be recorded as days of triumph for precious metals, but as a textbook example of the most cynical manipulation of the decade. We call it the Greenland Gambit. Let's look at the facts, dry, ruthless numbers behind which lie the incinerated deposits of millions of retail investors. In just 48 hours, we saw silver, XAG USD, skyrocket to an all-time high of $95.89 per ounce. It seemed that to the moon was inevitable, that $100 was a matter of hours. And then happened what is known in professional slang as liquidation. A pullback below 92.0, the instantaneous evaporation of billions of dollars in capitalization, and the crowd's complete bewilderment. What the hell was that? It was a show, and you paid for the ticket with your stop losses. Let's rewind the tape. To understand the mechanics of this robbery, we need to look at where it all began. January 20th, 21. The world froze. The White House issues an ultimatum. The wording is tough, old school style. Either we resolve the issue of Greenland's sovereignty, or our European partners, Denmark, Germany, France, the UK, get a trade war. The threat was specific, 10% tariffs on all imports immediately, with escalation to 25% by June. Do you understand what this means for algorithms? Robots managing trillions of dollars don't know how to feel irony. They see keywords, tariffs, trade war, escalation. Their logic is binary. If the world faces chaos, run to the bunker. Buy gold and silver. That is exactly what happened. The market instantly activated safe haven mode. It was panic buying. Investors, terrified by the prospect of supply chain collapses and Eurozone destabilization, began shifting capital into hard assets. They were hedging risks, believing that the dollar and euro would become toxic. Silver sliced through the $94 level like a hot knife through butter. The volatility index, VIX, soared. Green lights flashed on traders' screens. The logic seemed ironclad. Geopolitics is crumbling. Metals are rising. But here lies the anomaly. Look closer. While the paper price of futures flew into the stratosphere, strange things were happening in the physical market. Yes, a deficit of real metal has existed for the fourth year in a row. Yes, stocks on COMEX and LBMA are depleting. But this price spike wasn't caused because Samsung or Tesla factories suddenly needed more silver. No, industrial demand is inelastic, it is stable. This rise was a purely speculative bubble inflated by a news headline. Risk premium, that's what analysts call it, air. They were selling you air at the price of gold, convincing you it was insurance against the end of the world. The market was in a state experts call backwardation, when the delivery price for today is higher than tomorrow. This is a sign of panic. Buyers were willing to overpay just to get the asset now. They feared an exchange default. They believed Greenland would become the new Cuban Missile Crisis. And at that moment, when the crowd was maximally charged to buy, when every telegram channel screamed, buy, the main director stepped onto the stage. Switzerland, Davos, World Economic Forum, January 21st. All eyes are glued to the podium. Algorithms are tuned to analyze the US president's speech. The market waits for a declaration of war, confirmation of tariffs, something that justifies a silver price of $96. Instead, the Davos Pivot occurs. President Trump, the man who 24 hours ago threatened to crash Europe's economy, suddenly switches from anger to mercy. Calmly, confidently, he declares, "We have reached a framework agreement with NATO Secretary General Mark Rutte. No force, no immediate tariffs, just negotiations." What happens in that nanosecond? Imagine a rubber band stretched to its limit that is suddenly released. The fundamental reason for panic, the threat of a trade war, disappeared, evaporated. Disappearance of the risk premium. The speculative markup built into the silver price was annulled instantly. Newsbots, HFT algorithms that drove the price up received the stand-down signal and instantly switched to sell mode. Risk off for metals, risk on for equities. Capital rotation. Money that was hiding in silver flooded back into the stock market. The S&P 500 and NASDAQ, which had been trembling with fear, shot up. Liquidity was sucked out of precious metal ETFs like a vacuum cleaner. Avalanche of sales. Traders who went long at the highs were trapped. Smart money began taking profits at the expense of the hamsters. The dump began. Look at the chart. This is not a correction. This is free fall. Silver crashed, breaking the $94 support, and rushed toward $90. Do you understand the beauty of the game? The threat was a bluff. Tariffs were a pressure tool, but the market reaction was real. Someone made money on the rise, knowing the threat was a dummy. And then that same someone made money on the fall, the short, knowing the all-clear signal would sound in Davos. But if you think this is the end and the market just returned to normal, you are mistaken. This was only the beginning of the meat grinder, because the next day, January 22nd, the system struck a second blow, a blow that finished off the survivors. While investors tried to recover from the Greenland show, the U.S. Department of Labor published a report that became the coup de grace: jobless claims. A boring weekly report? Think again. Actual value: 198,000 claims. Forecast: 215,000. The psychological barrier of 200K was broken to the downside. What does this mean? It means the U.S. labor market isn't just strong, it is overheated. There is no recession. The economy is charging like a tank. And for the Fed, this is a green light to keep interest rates high. The higher for longer policy. And silver is a zero-yield asset. It hates high rates. If you can get a guaranteed 4.26% in U.S. Treasury bonds, yields on which immediately jumped, why risk it in silver? The dollar, DXY, squared its shoulders and started rising, trading in the 98.50, 99.0 range. And a strong dollar is a death sentence for commodities. It makes them more expensive for the rest of the world, killing demand in India and China. So here we are. Trump's Greenland Gambit created a wave that insiders rode, and labor market statistics slammed the coffin lid shut for those hoping for a quick bounce. It was the perfect storm, planned, or an accidental coincidence of circumstances? In the next part, we will stare into the abyss of the paper market and see how ETFs betrayed their investors in real time. We will dissect the data they are trying to hide behind the noise of the news. Have you ever wondered why the crowd always enters at the highs? Why, at the exact moment you need to be selling, does your finger gravitate toward the buy button? It isn't an accident. It is neurobiology multiplied by algorithms. Let's dissect the anatomy of the $95 trap. January 21st. Silver is storming the all-time high, 95.89 per ounce. All news feeds are screaming about the threat of war. Your brain, pumped full of cortisol, looks for salvation. You see green candles on the chart and think, this is just the beginning. It's about to break 100. If I don't get in now, I'll miss the trade of the century. This is classic FOMO, fear of missing out. And at that moment, when the emotional intensity reached its peak, the institutions snapped the trap shut. Look here. This is what they didn't show you on TV. While retail investors, hamsters, were feverishly buying up futures contracts and coins, smart money was already exiting out the back door. Data doesn't lie. In those 48 hours, a colossal amount of funds was withdrawn from the largest silver fund, iShares Silver Trust, SLV, $686.41 million. Think about that number. Almost $700 million left the market exactly when you were entering. The big players used your liquidity, your excitement, to close their positions against you. They sold you their risk at the maximum price. This is the psychological trap. You were forced to watch the political circus with Greenland so you wouldn't notice the whales unloading their portfolios. Graphic, schematic image of scales. On one side, paper silver. On the other, physical metal. The paper side drops sharply. But the cruelest part of this trap is the price illusion. What you see in your terminal is the price of paper silver. It is the price of obligations, derivatives, air. And this price collapsed. But try buying a real bar at this price. The market is in a state of backwardation. This is a market anomaly where the delivery price today is higher than the futures price for tomorrow. What does this mean in insider language? It means physical metal does not exist. Comex in London, LBMA warehouses are emptying. Major players don't trust the exchanges. They are taking the metal because they fear platform defaults. Traders see the spread between the spot price and reality growing. Paradox. The price on the screen falls because they are selling paper, while the deficit of real metal intensifies. You are shaken out of positions on stop losses, forced to sell paper at a loss, while the physical asset became even scarcer. It is the perfect robbery. They took your money without taking the goods. Part 4. Ironclad evidence. The crime in numbers. Now remove the emotions. Turn off the news. Let's leave only the dry math. We have ironclad evidence that the crash was technically predetermined and Greenland was merely the excuse. Exhibit number 1, the silent scream of the RSI. Look at the daily chart for January 21st, 22. The price updated the high, reaching 95.89. But look at the relative strength index, RSI. It did not update the high, it went down. This is called a bearish divergence. It is the most powerful technical signal that the momentum has exhaled. The market was screaming, "No more buyers, the movement is inertial." Any professional trader seeing this divergence and the RSI exiting the overbought zone would have hit the sell button without waiting for Trump's speech. Technical analysis predicted the crash hours before the political news. The news was simply fitted to the chart. Exhibit number 2, the candlestick verdict. Look at the close of the daily candle on January 22nd. It is a classic bearish engulfing, or evening star. A huge red candle that completely covered the optimism of the previous days. The price didn't just fall, it broke the critical support at $94 and tested lows in the 90 to 94 area. This is not a correction. This is a break in the short-term trend. The bulls were destroyed. Attempts to buy the dip choked. Exhibit number 3, divergence from gold. XAU USD also reacted, but look at the difference. Gold held up, losing less in percentage terms. The gold-silver ratio rose. Why? Because silver is a high beta asset. It grows faster than gold on euphoria and drops like a stone on fear. The market showed its vulnerability. Silver fell more than 4 to 5% from the peak in just 2 days. Exhibit number 4, the macroeconomic vice. Let's go back to the unemployment report. 198,000 claims. This isn't just a number. It is a signal from the Fed. The Atlanta Fed's GDP Now model raised the U.S. GDP growth forecast for Q4 2025 to 5.4%. 5.4%. That is not a recession. That is overheating. With such growth, the Fed will not cut rates. The yield on 10-year treasuries rose to 4.26%. The math is simple. Rising bond yields, death for silver. Rising dollar index, DXY, to 98.80, pressure on commodities. They sold you a story about the collapse of the dollar and the end of the system, while the U.S. economy flexed its muscles and the dollar strengthened. Fundamental data contradicted the news narrative, and those who looked at the reports, not Twitter, made fortunes on the short. Sound, a dull thud, like a heavy safe door closing. So we have a technical signal, RSI, screaming sell, institutional money outflow, ETF, at the peak price. Macroeconomic data, jobless claims, GDP, supporting the dollar, not metals. All the puzzle pieces fit into one picture. The Greenland crisis was a smokescreen, a perfect storm created to redistribute wealth from the impatient to the observant. But if you think the game is over and silver is now garbage, you are making a second mistake. Because while traders in the West count their losses, something very interesting is happening in the East. China and India don't look at COMEX charts. They look at their factories and their weddings. While Wall Street plays geopolitical poker, dumping paper contracts because of a single speech in Davos, a silent revolution is taking place on the other side of the planet. You are selling because you got scared? Excellent. Asia says, thank you. Let's widen the scope. What we saw on January 21st, 22 is a local Western hysteria, but the Greenland Gambit exposed a much deeper fracture, the rift between the paper market, futures, and physical reality. Look at China and India. These aren't speculators. These are vacuum cleaners. While the price on COMEX was falling, premiums on silver at the Shanghai Gold Exchange, SGE, remained anomalously high. What does that mean? It means metal costs more in China than in London or New York. The market is sending us a signal. Metal is leaking from west to east. This is arbitrage on a global scale. While American funds are locking in profits in dollars, Chinese importers are taking physical bars. Why? Because China is introducing strict export controls on strategic metals. They are closing the doors. They are preparing for a world where resources are more important than currency. The market is fragmenting before our eyes. Now look at India. There, silver is called the poor man's gold. Wedding season is in full swing, and Indians are buying metal, ignoring high prices. For them, a correction to $90 isn't a reason for panic. It's a gift of fate. But the main player laughing at your stop losses is industry. Do you think a solar panel factory will stop buying silver because Trump changed his mind about tariffs? No. Industrial demand is inelastic. They don't give a damn about the price. They need the metal for their product to work. Photovoltaic and electronics manufacturers continue purchasing even at prices above $90 per ounce. There are new drivers the news is silent about. Artificial intelligence, AI. Data centers and next-gen chips require more and more silver due to its unique conductivity. You are shorting silver but buying Nvidia stock? That is schizophrenia. Without silver, there is no AI. Green energy. The solar industry is already devouring over 15% of the global silver supply, and that figure is growing. Defense. In a world where geopolitics is decided by ultimatums, production of precision weapons is rising, and silver is an irreplaceable component there. We have a structural deficit for the fourth year in a row. Physical metal is lacking, exchange inventories are melting, and no manipulation with paper futures can cancel the laws of physics. You cannot close a deficit with a president's speech. So, what happens next? The spring is compressing. We are at a bifurcation point. On one side, manipulators with their algorithms and strong dollar. On the other, real deficit and greedy Asia. Analysts at the biggest banks, the very ones cheering you on volatility, are writing something completely different in their private reports. Look at Goldman Sachs. They raised their gold forecast to $400 by the end of 2026. Given the historical correlation of metals, this automatically sends silver to space, to levels of $100, $110 per ounce. Citigroup is even more aggressive. They expect $100 per ounce by March 2026. The London Bullion Market Association, LBMA, runs surveys where the consensus is a doubling of the silver price in 2026. They know the system is breaking. They know the paper game is finite. Here is your navigator for the coming weeks. Write down these levels. Scenario 1, baseline, probability 60%. Attrition. We will see consolidation in the $90, 94-hour range. The market will lick its wounds. Major players will accumulate positions in this corridor, wearing down the nerves of retail traders. The $90 level is a concrete slab. Buyers of physical metal have orders parked here. If the price touches this bottom, it will be bought up instantly. Scenario 2, bearish, probability 25%. False breakout. If the dollar continues to strengthen and bond yields rise, we might see a puncture of $90. The price could visit the 85 zone. Powerful moving averages pass through there. And you know what? That will be the best entry opportunity of the decade. That is the zone where smart money will be loading up train cars. Scenario 3, bullish, probability 15%. Explosion, a new geopolitical shock, or inflation data that turns out worse than forecast. Any spark can return us to 96 plus and an assault on $100. Backwardation hasn't gone anywhere. The deficit hasn't gone anywhere. Part 7, finale and call to action. Don't play by their rules. Sound, music swells, tense, epic soundtrack. The camera slowly zooms in on a silver coin lying on a table. The Greenland Gambit was a lesson. Cruel, expensive, but necessary. They showed you how easy it is to control the crowd with fear and headlines. They showed you that the price on the screen is not the value of the asset, but a thermometer of emotions. You can continue playing the casino, try to catch these moves, short on news, buy at highs. But remember, the house always wins in a casino. Or you can understand the essence of the game. The system is built on debt and paper promises. Silver is the antidote. It is chaos to their order. The current correction is not a crash. It is a sale. It is a chance to take the real asset from those who are panic swapping it for cut paper. Remember the words of Bob Habercorn. This is a perfect storm. And in this storm, the one who holds the wheel survives, not the one running around the deck. Watch the $90 level. Watch the outflow from ETFs. And don't believe politicians when they talk about markets.